Hello, my name is Thomas Key, and I am President and CEO of Stock Traders Daily. The stock market is all about money, but more precisely, it's about new money. We can't expect markets to grow if we churn money that already exists. It's just not going to happen without the contribution of new money. So if you want to know where the market's going to go, focus on new money. The next logical question is, where does new money come from? It comes from you and me, from people who are saving money over the course of their natural lives, based on ingrained societal norms that has encouraged them to do things like buy a house, put their children through school, and save for retirement. These things matter to the demand side of asset equations over time, and they have been darn precise when measured against longer-term economic cycles dating back to 1900. This is the investment rate. It measures the rate of change in the amount of new money available to be invested into the United States economy dating back to 1900 and recently extended as far as 2062. This chart shows about to 2068. It also shows a defined upward slope, which is good because over time we can see that more and more and more new money is coming into the market. You might be surprised what you see when we look out to 2062. Make sure you read the update that's on our website pertaining to that, but that's a very long-term observation. Looking back, though, at this chart that's already existed and patterns that have already happened, we can see three clear down channels in the investment rate. The investment rate is a leading indicator, so it's telling us what demand is likely to look like going forward as well as today. And when we look behind, we can see that this cycle had a bookend between 1928 and 1938. This down cycle in the investment rate, the first major down cycle, was the Great Depression. The second one was stagflation. And this third one started exactly when the investment rate told us to expect it. But that didn't last. We haven't gone straight down. This was December of 2007. And this cycle, this down cycle in the investment rate, lasts until 2023. So about 5 or 6 more years. But we haven't gone down like this. We haven't seen the stagflation and Great Depression-like concerns, at least not yet. But we are in a declining investment rate environment. So what does that mean? What it basically means is that there's actually less new natural money coming from investors ingrained by societal norms on an annualized basis during this down period. That doesn't mean that there's no demand. That means that there's lower rates of demand. Think, just for general sake, 100 billion, 90 billion, 80 billion, just for the sake of conversation. So there's less money available to flow into investments, and when demand levels decline, natural demand levels decline, risks often are perceived to be higher. And that can affect the stock market and the economy in general, and then all the things that are important to us. So in a declining investment rate environment where natural demand levels are declining, we absolutely should be concerned. And initially, I think we were. I think everybody was, because they could see that something was wrong. So how long will the declines last, was the question. But then Ben Bernanke stepped in, and more power to this guy. He actually staved off what would likely have been a greater depression. So I think from that perspective, saving the banks was fabulous. But another thing they did was completely offset natural cycles. And specifically, as the investment rate declines from 2007, and this was through the end of stimulus, as the investment rate declines, the Fed balance sheet increased at such a rate as to create a substantial skew in what now was a combined natural and unnatural rate of demand, where the investment rate was defining natural changes in demand cycles over time. The influence here of stimulus skewed that considerably. And in fact, demand levels, and this was in 2014 at the end of stimulus, at the end of 2014, demand levels were 66% higher based on our quant work than where they would have been just with natural demand and no stimulus. But just then, as soon as the FOMC stopped its bond buying program, the ECB began one of its own. It was like handing off the baton. And the ECB is still actively engaged in stimulating the economy, in buying assets directly to influence asset prices as well. But that's a big concern. Yeah, liquidity has been great. But what happens when that liquidity dries up? This is extremely important. Because if the natural rate of change in the amount of new money is declining like the investment rate says, and we are not only skewed by 66%, but something probably greater because the ECB has been doing this for about a year and change now. Well, what happens when that liquidity spigot gets turned off? The answer that I'm trying to communicate to people is that it's likely going to result in a crisis in liquidity. So all of this free-flowing money that we see right now, it's going to change when that fabricated bid goes away. Now, I can't be sure of this, but clearly everyone wants to know when. When is it going to happen? And that's extremely important. I know. The answer to that, though, is we need to watch. And that's what we're going to do at Stock Traders Daily. We're going to watch for that turning point. And it's not today. This is October 20th, 2017. And the market on this particular day was extremely strong. And it had been consistently recently. And there are no reasons to expect it to turn down abruptly given these chart patterns. But one day that's going to come. And given the upcoming ECB meeting and the likely changes that they're going to be making to their policy directives, the probability that that fabricated demand spigot gets turned off is extremely high. This is the time when we should be recognizing the risks. This is the time when we should be paying attention for dramatic shifts or signs that dramatic shifts will come. And we have been exceptional at doing this over time. I started this business in January of 2000. We made a tremendous amount from the internet debacle that followed. 250% in 2000 and about 150 in 2001 and 2002. We did fabulous then. We identified the bottom within 5 S&P 500 points. We identified the top in 2007. And we're pounding the table in February of 2009. We're good at identifying these longer-term shifts, and we're going to watch them for you. Don't get distracted by the other things that we're going to do. We're going to offer strategies that you should look at. We're going to offer analysis on a regular basis that you should review on occasion at least. But the most important thing that we are going to do is we are going to tell you when that asset bubble we are in today is about to burst. That's the most important thing that we could give you. In order to get that, because we don't know exactly when it's going to happen, but we're watching, you need to be a subscriber. If you understand that risks exist and you want alerts from somebody who has been through each of the past 2 major market crashes and who has thrived, we did 60% in 2008, then we're for you. I'll give you a grandfathered rate if that's you. Reply to an email or go to our website, stocktradersdaily.com, and email us through the website and reference grandfathered rate with a discount code of IR66. That's shown right at the bottom here. IR66. If you do that, I'll give you the details on a grandfathered rate. That's especially for people who have listened to this video and who recognizes that, yes, there are risks out there, and I do want to know when they will escalate and what my alternatives are. Thanks a bunch. Have a great day.